In this video, I'm gonna break down exactly how I leverage debt and how I'm $1 million of debt and how I use the debt to make more money. Let's get into it. Let's say you have $100,000 saved in the bank. Now, this $100,000 is not making you money, especially if you have it in the bank or you have it underneath your mattress. And the reason why you are losing money, even though you were taught to save money, is at the end of the day, this same $100,000 is going down in value, meaning the same buying power that you had 5 years ago with $100,000 is not the same value that you have in today. Now that same $100,000 is probably worth $90,000, $80,000. I don't know. We live in some crazy times where the US dollar is continuously devaluing. Now, if you put this in the bank, most of your big banks, Chase, Wells Fargo, JP Morgan, all of those bank accounts, typically they are paying you less than a penny on interest rate. And so that means that every single month you are probably paying a servicing fee, which is typically $5, $10, $15, and you are getting paid 0.01% on your money. So that means you are losing money every single month that this money is stored in the wrong places. In this video, I'm going to show you how you could take that same $100,000 and leverage it to get into debt to make more money. Now, you might be asking yourself, well, Chris, should I go out there and take this $100,000 and buy one house? My answer to that is always going to be no. And the reason why is you need to learn how to utilize debt to maximize your dollars. So I'm going to give you an example. Let's say you go take this $100,000. So you're going to take this $100,000 and you're going to go buy this house. You're going to buy it cash. So you're going to spend all your $100,000. You're going to buy it cash. And let's say you could rent out this house for $1,000. So you're going to rent this out for $1,000 monthly. So yes, that means if you go buy this house for $100,000, you're going to be making $1,000 monthly, which is equivalent to $12,000 yearly. So now you are generating passive income. This is taking all of your cash and not leveraging the bank, not getting into debt, and you're going to be making $1,000 monthly. Now, the biggest thing about why you want to invest in real estate is because not only is it a cash flowing asset, one, it's an appreciating asset. So it's going to go up in value. Now, I'm going to share with you 3 rules about money and how money works. 1, you got to learn how to get money. Everybody knows how to get money. You can go start a small business. You can go out there, wash cars. You could start a lemonade stand. Go get your money. 2, you need to learn how to keep your money. How do you keep your money coming back? And no, I don't mean to go save this in the bank and lose the money. You need to figure out a way how to make that money keep coming back. Cash flow, baby. And 3, you need to learn how to multiply your money. What I mean by multiply is when you put your money to work, you need to learn how to make that money grow. This is why real estate is one of the best places to put your money because 1, you get to make money. 2, you get to keep your money. And 3, with the appreciation, you are multiplying your money. Let's get back to over here. This property is going to go up in value. Typically, real estate will go up anywhere between 3 to 5% in value yearly. So we're going to keep it at 5% just to round numbers. So now this is going to go up 5% yearly. So in 5 years, a $100,000 house goes up 5%. That means it's going to go up to 105 year 1. 110 year 2, 115 year 3, 120, and then by year 5, so we're gonna go over here, we're gonna write right here an arrow. By year 5, this property is now worth $125. However, remember, you bought this house cash, $100,000. It went up in value 5%, and you were making $1,000 monthly. Now, this is, of course, you have no repairs on the property, no maintenance, low management fees, etc. So I'm just using this to keep it simple so you get the idea. In $12,000, so year one, you've made $12,000. $12,000 year one, you can multiply that times 5. I believe that is $60,000. So you made $60,000 in 5 years, and you made $25,000 in equity. That's about $85,000 in 5 years. Now, let's say, Chris, how does debt work? I'm going to show you how to leverage debt to maximize your dollar and make more money by getting into debt versus not getting into debt. If you were to take this same $100,000, you can utilize creative finance the way I go buy properties and get probably 10, 15 deals out of $100,000. But let's say you go out and it costs you on average 10% to buy a house. So we're going to say it's going to cost you 10% to buy a house. So that means it's going to equal to $10,000. And you're going to leverage debt to go out there and buy these houses. So that means you only need to put $10,000 down, and they're going to finance you $90,000. Whether it be subject to the bank, whether it be seller finance, the seller, you're going to get in debt. With this same $100,000, instead of buying a house cash and having one appreciating asset, now with that same $100,000, you are going to go buy 10 houses and have 10 appreciating assets. Now, yes, you might be saying, okay, you go buy 10 houses, but now you're in debt. That means you're going to be in debt $90,000 per house. So we're going to do per, so which equals to a total of 90 times 10, $900,000 in debt. So now what's going to happen is you have a payment. You have a payment on this $900,000. So just for round numbers, we're going to say your payment on this $900,000. Remember, you could rent it out for $1,000. Now, your rent is going to be the same houses. You're going to say $1,000. You're going to say $1,000. But now on your debt is now going to be equal to $900. So that means you are only going to be making $100. Now, don't forget management fees, maintenance, all that good stuff plays a role into here. So that's why you got to be making sure that you are buying amazing deals. However, we're using this for the example, $100. So now, instead of making $1,000 a year on one property, now you're only making $100 per property. So you're making 100 here, 100 here, 100 here, so on and so forth. You're making $100. So if you do $100 times 10, you're going to multiply because you have 10 houses. We're going to redo that house right there. Now you have 10 houses. That is equal to the same $1,000 that you were making before. However, instead of only making $1,000, now you have 10 appreciating assets that are going up in value every single year. So now, if your value is increasing 5% yearly, that means it's 25% after 5 years. 25%, which is also equal to $25,000. So property went up $25,000. So you're going to multiply that times your 10 houses. So now we'll do the math. Instead of only having one house, same time frame, 5 years, now you have 10 houses that went up in value $25,000 times 10. That means now you have made over $250,000 in equity. In equity. You have $250,000 in equity. So let's go back to the debt situation. Let's say you don't want to get into debt. You go buy a house cash. You've only made $1,000 monthly, $25,000 in equity. Remember, the house was worth $100,000. It went up to $25,000. So you only made $25,000 in one house. Versus taking that same $100,000 and going to buy 10 houses. So now you go buy 10 houses. You get into debt, $900,000 into debt. However, these 10 houses go up in value in 5 years at a 5%. Right here, 25,000 times 10. That equals $250,000 in equity. Now, a lot of the times we tend to not understand how equity works. The way you go get your equity out is you can go get a line of credit or you can do an equity refinance where now you refinance the property, you take out the equity, the bank will always lend you on an asset. So let's write that down. Banks will lend on assets. So that means you can go get a loan, you can go get debt on a property. That's going to allow you to go out there, create cash flow, create appreciation, and you get to take the tax depreciation on your real estate. I hope you learned something from this. If you did, please comment down below. Let me know how I could help you understand money more, understand debt, and help you get into the game. My name is Chris Silva. Make sure you guys follow me on all of my channels, LinkedIn, Instagram, Facebook, X, and like, comment, and subscribe, and I'll see you on the next one.